Want to take control of your financial future? Or are you confused on how to approach the stock market? Watch this video till the end and learn about an investment strategy that has consistently beaten the stock market and discover how you can use it to achieve your financial goals. Hi guys, welcome to our channel Omega Finance. Today we're here with another informative video. In this video, we'll talk about Warren Buffett and his all-time famous value investing strategy, not to forget the CEO of Investors Business Daily, William O'Neill, and the face behind the CANSLIM investing strategy, and last but not the least, the famous Peter Lynch and his Rule of 20. In this video, we'll talk about how to put their market-beating strategies into practice, so you can also beat the stock market. Now, without wasting any time, let's get into it. The number one strategy is beating the market with the CANSLIM method. William O'Neill created the CANSLIM stock investing approach to deliver market-beating profit performance. Profitable returns on your investments should result from using the CANSLIM criteria. Essential criteria are current earnings, yearly earnings, new products, supply, leaders, institutional sponsorship, and market direction. It creates a coherent strategy by fusing fundamental analysis and technical analysis. The CANSLIM criteria says C is for current earnings, A for annual earnings, N for new products or management, S for supply and demand, L for leaders, I for institutional ownership, and M for market direction. You can study further details from the link in the description below. Now, how can we implement the CANSLIM formula? The best way to implement this is to look for companies with good profiles, great market cap, high current earnings, annual earnings, and supply and demand. For example, REC is a well-renowned firm with high earnings and market cap. Also, its dividend yield was 12 to 16% and it is a comparatively stable stock. So, according to CANSLIM, it's a good stock to invest in. The second strategy is Peter Lynch formula. Peter Lynch has presented a formula which is famous for helping you beat the stock market. The formula focuses on picking stocks that have the potential to give you excellent returns, thereby emphasizing the importance of researching potential investments. Peter Lynch's strategy is divided into three main parts. First, you need to consider the PE ratio, or the price to earnings ratio, which compares a company's current stock price to its earnings per share. The lower the PE ratio, the more attractive the stock. The second thing to consider is the growth rate. For determining the potential of a stock, its growth rate is evaluated. This can be done by looking at the company's past performance and future growth potential. The third thing is potential. The last part of the Peter Lynch formula is determining the stock's potential. This can be done by looking at the company's management, industry trends, and the overall economic environment. The Peter Lynch formula is an incredible way to evaluate a stock's potential for investment. By combining these three critical factors of the formula, investors can better understand the stock's potential and make more informed decisions. Following Peter Lynch's Rule of 20, you can beat the stock market easily. These rules help you find potential stocks that are undervalued and poised for substantial growth. Particularly, the Rule of 20 says that a stock value is attractive if the price to earnings ratio is less than or nearly equal to 20 minus the inflation rate. The Rule of 20 is that stock prices ought to represent the value of the underlying company minus an inflation premium. Lynch said that if a stock's PE ratio is equal to the rate of inflation, then the stock price merely reflects the effects of inflation and not the possibility of the company's future growth. Lynch contended that a stock price equal to or lower than the inflation rate is therefore undervalued and may present investors with a compelling opportunity. Investors can use the Rule of 20 to determine if a stock is inexpensive by using it as a starting point. Lynch said that in addition to the PE ratio, investors should consider the company's fundamentals, market movements, and macroeconomic conditions. The next strategy is regarding value investing with the Warren Buffett method. Over the past 50 years, Warren Buffett has established himself as the most significant investor of all time. He and his close buddy Charlie Munger have a track record that Wall Street can only aspire for, with an average compound annual return of 23.3%. His business, Berkshire Hathaway, is now a $500 billion giant because of his astute investment decisions. But how did Buffett manage to generate such great investment returns? He is the best at stock analysis and knows what makes a great business. The New Buffettology, written by Mary Buffett, contains the most thorough examination of Warren Buffett's investing strategy. The two most crucial standards developed by Buffett's mentor, the great Benjamin Graham, fair value or intrinsic value and margin of safety, will also be used along with the Buffettology book. How does Buffett screen for stocks? Buffett selects companies based on criteria. Whether the company is profitable and producing a solid cash flow, the cash flow is then foreseen and discounted 10 years in the future. Suppose the cash flow value exceeds the company's stock market valuation by 30%. In that case, the company has a reasonable margin of safety and is a contender for purchase. Specific rules for the Warren Buffett investment include looking for a fair value higher than the current stock price, a strong earnings per share history and growth rate, a consistently high return on equity, a high margin of safety, the initial rate of return for the stock greater than the return on US Treasury bonds, does the company earn a high return on total capital, and is the company conservatively financed? He said, you don't really need brains. What do you need? You need the right orientation. 90% of the people, I pulled that figure out of the air, but 90% of the people that buy stocks don't think of them the right way. They think about something that they hope goes up next week, and think about the market as something they hope goes up. And if it's down, they feel worse. I feel better. And you think about it. I think of what the company will be worth 10 or 20 years from now, and I hope it goes down when I buy it because I'll buy more. I try to keep my competitive spirit in a game where I can win. I do know that. When I want to do something, I always want to do it big. Another great strategy to beat the market is Klarman's margin of safety method. Purchasing equities with a high margin of safety entails minimizing trade risk and maximizing potential profit. Elite investors Seth Klarman and Warren Buffett contributed to popularizing the margin of safety concept. Here you're wondering, what is the margin of safety? The margin of safety is the percentage difference between a company's stock price and the actual worth of its assets and cash flow, that is, its income. This is the reduced cost of purchasing stock in the company. You receive a discount of 50% if a company's stock market value is $5 per share, but its earnings, assets, and brand are worth $10. If you purchase the stock for $5, it should increase by 100% to reach $10 per share. The margin of safety is the percentage difference between the stock price and the company's real fair value, the amount by which a corporation is undervalued on the stock market. In other words, the margin of safety is the ratio between the fair value of a company's shares and the price at which it trades. Investors have a margin of safety if a business has assets and profits more remarkable than its stock market valuation. The better, the greater the margin of safety. According to traditional value investing theory, the margin of safety is the amount of risk an investor can tolerate. The risk a stock buyer assumes is estimated by the margin of safety. Warren Buffett's explanation of margin of safety: if you understood a business perfectly and the future of the business, you would need very little in the way of margin of safety. So the more vulnerable the business is, assuming you still want to invest in it, the larger the margin of safety you'd need. If you're driving a truck across a bridge that says it holds 10,000 pounds, and if you've got a 9,800-pound vehicle, if the bridge is 6 inches above the crevice it covers, you may feel okay. Still, if it's over the Grand Canyon, you may want a more considerable margin of safety. In the end, the value investing approach depends on calculating fair value and margin of safety. Suppose you want to generate solid returns over the long run. In that case, you should purchase businesses now trading at a considerable discount due to market irrationality. For more details, refer to our video, The Intelligent Investor Summary, The Warren Buffett Investing Style. The link is given in the description below. That's it for today. Please remember, we are putting stats and info in front of you, which is based on the previous performance of these stocks. This is meant for educational purposes only, so we aren't responsible for any profit or loss. You can have a proper financial consultation before investing. So what do you guys think about this video? Please share your reviews about what you think about the video and let us know what investment strategy you would be adopting that can help you beat the stock market. Hope you liked this video. If you did, remember to like, share, and subscribe to this video. Stay tuned, as we will come up with many more new and more informative videos. Till then, goodbye.